Let's get in Suyash Chaudhary, Head of Fixed Income from IDFC, joining in on the show. Good morning, Suyash. We are just about 8 days away from RBI policy, and we are already looking at macro situation which is relatively eased off. How are you observing the trends, and what is the bond market pricing in right now?
As a base case, the bond market is not expecting RBI to incur any further rate hikes. With inflation coming off, current account deficit relatively well behaved, it is quite likely that RBI adopts status quo, especially as the forward 2 inflation readings that we will see in months of February and March should also be lower. Having said that, I think a big trigger for bonds can potentially materialize if RBI does or takes further steps to adopt overnight rate around the repo rate. So if you look at it so far, when this whole episode of currency defense started on 15th of July, it was always guided that the MSF will be used to attack the currency, and when it's down to attacking inflation, we'll be back to the repo rate. Whereas today, if you still look at it, the overnight rate gets anchored closer to the MSF than the repo rate. So if the RBI were to take further measures in terms of relaxation, let's say of NDTL caps on various liquidity windows, so that call rate falls towards 8%, that is something bond markets will look forward to.
Suyash, if I can direct a question that Avan directed at me at the opening of the session to ask that what sense do you make of the RBI's OMO at a time when yields are coming down? Is there any evidence of tightness of liquidity in the system? What is your interpretation of the RBI's OMO?
Well, although we are surprised, there is logic for it, and let me just take you through the logic. If you look at how RBI has conducted OMOs over the last 3 to 4 years, it has always been to address structural deficits in liquidity and not necessarily arresting bond yields. So if you look at between 2009 and 2012, typically most of the OMOs used to get bunched up between November and February and March, which is when busy season used to take away a lot of liquidity from the banking system. Now, the change that we had witnessed under the new regime was that the last 2 or 3 times when they have announced OMOs, they have explained it in context of tight liquidity as reflected in higher bond yields. So which is why the confusion in the market that if tight liquidity gets reflected in higher bond yields and bond yields are falling, then by logic liquidity is not tight. However, if you were to look at liquidity on an absolute basis and not correlate that to bond yields, we are today sitting at a deficit of around 1,40,000 crores, which is towards the higher side of the band that we have ever experienced over the last 3 odd years. In fact, if you were to look at future calculations for liquidity going into March, if RBI were to not do anything, it will further deteriorate by around 20,000-25,000 crores. So does the case for permanent liquidity injection exist via OMOs? Yes. But the way they have explained it so far, that tight liquidity reflects in higher bond yields, that's not the case today.
Well, certainly I would agree with you on that, but tight liquidity necessarily does reflect in, yields. You cannot have one without the other. So the argument that the RBI has been making, to my mind, seems a little suspect, beyond which, when the RBI suffuses liquidity, because, at the time, basically what are they trying to support? At the time when the economy is slowing, you've seen the IIP falling, one's seen GDP for these numbers for this particular year is likely to be less than 5%. So is the RBI kind of encouraging asset bubbles in a way, because if there is no productive activity taking place and bond yields are falling, what is the case really for liquidity infusion?
Well, the simplest case would be that the system liquidity deficit at this juncture is higher than what is required to support even what they call the productive requirements of credit. Now, I understand the perspective you are coming from, which is that the guidance or the interpreted guidance of the market for the last 2 to 3 months seem to be different as far as OMOs are concerned. But I would disagree with your inference that tight liquidity necessarily leads to higher bond yields. If you look at the experience over the last 3 years, liquidity is the tightest during busy season, and especially between Jan and March, but that is when bond yields have tended to fall. For the simple reason that liquidity deficit gets plugged by OMOs, therefore the net demand versus supply equation for government bonds improves dramatically, and that simply leads to rise in prices and fall in yields. So it's something of the same that we are witnessing right now. The confusion in the market would be much lesser if the last 2 or 3 interventions RBI had made, they had not explained tight liquidity versus higher bond yields and simply done OMOs to plug liquidity deficit as an absolute number.
What is your sense? Will the government really be able to abide by that fiscal deficit target? They've already, deferred or postponed or maybe even cancelled their bond auction. So what does that mean? Does that mean the government is going to be able to achieve that? Or are we going to see much more borrowing happening after the vote on account on February 17th? Because once the vote on account is done, then the finance minister has virtually a clean hand. Nobody's really going to ask him any questions.
At this juncture, I have no reason to dispute the 4.8% deficit target. In fact, there were sources in the finance ministry that were even talking on the news wires of something like 4.65%. Now, I would look at it under 2 aspects. One is clearly, and that needs to be applauded, that even in a tough economic condition, the finance minister is willing to drastically cut down expenditure, or at least not release fresh monies for future expenditure. So the numbers one here around plan expenditure savings is of the order of in excess of 1 lakh crore. However, there is one more leg to it, which is basically this, that there is a lot of rollover that happens of expenditure of this financial year into the next financial year. So as long as that practice continues, it is only a matter of rolling forward a little higher than what was being considered to be rolled forward earlier. So from that perspective, it's not that difficult to rather meet that 4.8% target, because any surplus can easily be rolled over to the next financial year. Having said that, and like I said before, let me reiterate, the exercise of cutting expenditure in the face of a tough economic environment clearly shows serious intent.
Right. So Yash, I wanted to ask you, right now we are looking at yields heading back to around October lows, but what is the kind of range have you penciled in this year, assuming that inflation in Asia's 3rd largest economy cools a little bit, and RBI also gradually, however gradual it might be, start adopting easier stance, monetary policy stance? What's the range you see yields move in?
Look, in the very near term, which is the next 2 months or so, we are relatively constructive on yields, and that comes from the perspective that rate hikes are pretty much done. Like I said earlier, there is a possibility that RBI moves the setting of the overnight rate closer to 8%, which is effectively, if you look at it from current juncture, it would almost amount to a possible easing of rates. Secondly, inflation is falling, and over the next 2 prints it should fall further. And finally, bond supply till March is virtually zero. So these factors should keep yields on relatively well behaved. The number we are looking at right now is a range of 840 to 865. After March, the situation gets a little more hazy, because you will start a new borrowing calendar. Given the upfront maturities that are due in the next financial year, it's likely that the gross borrowing program is much higher than last year. Secondly, there are elections due, and if there is some jitteriness in the market around that time, that can also tell on currency and rate. So, post March, I would look for gradual drift up in yields to some extent, but till March we remain quite constructive.
Suyash spoke about how the finance minister would be able to achieve that fiscal deficit target for 2 reasons. One is cutting down on plan expenditure, and 2, he may roll over some expenditures over next year. Both of these are not very desirable practices, certainly, because when you cut down on plan expenditure, it impacts growth. And when you roll over expenditure, you're basically tarring over the blemishes in the budget exercise. Now, markets are smarter than finance ministers. So do you think the market will just believe the number that he gives, or will they look beyond and say, look, this is not the true picture, so we need to have a higher rate on the bond yield?
Well, market looks for opportunities. So if market senses that there is an opportunity, wherein one can make money of bonds, the market will take it. So I think at this juncture, that is really what is going on. No one is very sanguine about the fiscal deficit picture, and certainly not about bond supply in the next financial year. But what remains the case right now is, and the positives that I listed out, owing to those, the next couple of months look relatively benign. So market is just trading that benign period with a wary eye to the future that come April the situation may turn out to be different.